Welcome everyone. Happy Halloween. So
Happy
on the
Halloween.
screen, we have Croft and me, Dr. Sherry Hu. Today we are going to talk about a very, very good topic. It's a weathering market volatility and protecting your retirement in today's market. So I know many of you have already met me and probably have already been my clients. And I'm very glad we have our very honored guest speaker here. So we'll talk about this very good topic. And before we start, I want to remind you to mute your phone because today's information is very important. You don't want to get distracted. And you probably want to bring a notebook here so you can take notes. And you can always ask your questions when you hear anything you want to ask in the chat box. And in the end, we will let you talk. If you want to talk, to ask your questions or chat with us, you are welcome. And you also get a chance to make appointment with me and with Croft when you want to know more about, when you want to find out more about your specific situations. We'll let you know how to do the appointment in the end. So with that said, I want to talk a little bit about me. I know many of you have met me, and I'm founder and the president for Beyond Academy. This is an organization to help with college planning, especially college funding planning. And we also do business as Peace of Mind Finance. That's another branding of us to provide college and retirement planning, and also to help you to protect your asset, to do the wealth management. And we are very, very honored to be selected as Wells Fargo's strategic partner. It has been through very stringent scrutiny, and we have done all the great work. So Wells Fargo selected us as a strategic partner. So today I'm going to introduce Croft Meeker, you see on the screen here. So Croft has many, many years of experience, and he has been doing tradings and financial operations in the past. And also he has worked for Citigroup to grow the asset management and work on the fixed income distribution. For the past several years, he joined Wells Fargo. He joined Wells Fargo because Wells Fargo is able to provide a lot of additional resources to the customers. So that is one thing I want to let you know. You probably all know Wells Fargo as a very good bank. And Wells Fargo is also the top wealth management brokerage management providers. And Croft will talk about how Wells Fargo can bring additional resource that you will not be able to get from any other places. So with that said, I'll ask Croft to start today's topic.
Great. Well, thank you very much, Dr. Sherry. So yes, I joined Wells Fargo about 3 years ago, left Citibank. And the reason I did, like Sherry said, there's a lot of resources and capabilities that Wells Fargo has on their platform that I felt helped me serve my high net worth clients at a much higher level than I could at Citi. Wells Fargo is, like Sherry said, we're among the top 4 biggest brokerage firms in the country. Me being in the business doesn't surprise me. Well, that does surprise a lot of people. They don't think of Wells Fargo as an investment and brokerage firm necessarily. So we are among the top 4 biggest in the country, and we have operations, across the country. As you know, we're a national footprint. So I sit and work in Florida, although I have clients all over the country. And I'm very excited to work with Dr. Sherry Hu and her group to provide financial wealth management through investments and help clients reach their goals for retirement and investing. So this presentation, I think, is very timely. Market volatility is with us, obviously, with the upcoming elections, with COVID, things like that. But the information in this presentation, I think, is good for any market that you're in. It's just good baseline investment advice. So let's see here. So market volatility, there's nothing new about market volatility. On average, we see a bear market about once every 6 years, and that bear market on average lasts about 401 days. The last bear market we actually just touched in March and didn't last anywhere near 401 days. It lasted maybe just a month or two. So, and we've obviously recovered quite a bit from there. You know, every time a market, there's a bear market, markets over time in the last, since 1950 have gone on to reach new highs. So one thing we stress is important is staying in the market, develop a plan, and stick to that plan. You can do the next slide. So one of the things we try to have clients do is develop a strategy and execute it. And a couple of things that we want to understand are, what are your objectives? Obviously, everybody's in the markets to make money, but the more specific you can get on your objectives, the more likelihood we'll develop a strategy that can help meet that objective. What's your risk tolerance? Are you do volatile markets scare you? Do you want to take less risk, even if that means perhaps not earning as much as you would in other portfolios? Are you okay taking some risk in order to get some growth, or do you see yourself as a very risky investor, and you're okay with seeing big ups and downs in your portfolio? Another thing is time horizon. How long do you have to reach that goal? And that goal could be saving for college. It could be saving for retirement, buying a new home, whatever that goal is. What's your time horizon for that? And then we look at asset allocation. How are your portfolios invested between the major asset classes like stocks, bonds, and cash? And then, you know, how often do we review it and then adjust the portfolio as we need to? So determine your current situation. How is your portfolio allocated among the stocks, bonds, and cash? You know, how much debt are you carrying? How much short-term debt are you carrying? How much long-term debt do you carry? Until you really understand all those things, it's hard to develop a plan. So when I sit down with clients, these are all things that we answer, and that in the first conversation, we really kind of gather all the information to start building out a financial plan using our proprietary planning software called Envision. It's a great platform, great software that really helps give us a good idea of where we're headed, you know, in retirement and in the future. Next slide. Next slide. So what are our objectives? You know, a lot of people want to obviously have a nice, comfortable retirement. Those that might have enough wealth, they want to consider paying for college or education for their children or even their grandchildren. Is it important to you to leave a legacy behind to when you pass? You know, to build a legacy that you could leave to your children, or even a cause that you care deeply about, like charity. All this is stuff that we plan with our clients on. Charitable gifting and things like that for high net worth individuals is an important part of the financial plan. Your risk tolerance, we touched on that a little bit. You know, how stable do you want your portfolio to be? Are you okay giving up some gains to have less fluctuation in your portfolio in the principal value? Are you okay taking some risks, but not a lot, and don't want to see your portfolio fluctuate too much? And then again, there's some people that want to shoot for the moon. And as long as you have the right time horizon, the right risk tolerance, the right appetite for it, and what your goals are, that could be something we look at. But each person is unique. Each person's an individual. And so it all starts with a conversation and understanding, what kind of an investor you are, what are your goals, and we develop a plan together to help you meet those. So your time horizon, if you're younger, if you're 30 years old, you could have 30 to 40 years of working before you plan to retire. I have some clients that don't ever plan to retire. They love what they do, and they'll do it as long as they physically can. So retirement means different things to different people. I think for the most part, retirement means financial freedom, the freedom to do what you want to do with your time. So if your time horizon's fewer than 15 years, we want to look at the proper allocation for you for that kind of time frame. Maybe we have a little more balance between stocks and bonds and cash, so that you don't, if there's a market event, if there's some volatility in the market, you're not having to make up too much before you retire. If you're 15 to 30 years away, that's a market cycle is typically about 10 years. So you have time to weather a market cycle in that way. You can be very aggressive and be mostly invested towards stocks for aggressive growth. But most of our portfolios, we always have an allocation to some of the three major asset classes between cash, stocks, and bonds. So here's an example of a moderate growth in income objective. About 75% in stocks, 16% in fixed income. And when I say fixed income, just so people know, fixed income and bonds are kind of the interchangeable language, and equities and stocks are the same. Real assets are things like real estate and commodities and things like that you can access through different securities. And then we always have some sort of allocation towards cash. Cash can be is typically just your checking and your savings. Some people may want to raise cash to fund projects like home renovations or things like that, repairs. We always recommend clients have 3 to 6 months of cash on hand if something happens like a job loss or a death in the family or some disruption to your monthly income. It's a good idea to have a substantial cash to at least be able to support 3 to 6 months of your income. So this is more of a long-term model, obviously much more weighted towards equities and a little bit of fixed income and real assets and cash. And then the next slide. And then on the other side, this is a much more conservative client. This might be somebody who is 5 to 10 years from retirement or in retirement. Obviously, they're almost 90% in fixed income, which gives them income. But also, when we look at fixed income, it helps buffer a portfolio. The total return of a portfolio is not just the growth of it, but also the income it produces. And so fixed income in good markets can help bolster a portfolio's performance because you're also getting the income from it. In bad markets, the income can help dampen the downside effects of a bad market. So we really look at fixed income that's why we always have some sort of allocation to it. It's critical to have a well-rounded portfolio. Next slide. So we just touched a little bit on that, why we hold these different asset classes. So cash is important, as we said, for immediate needs, things that coming up in short term, and then like I said, for projects and for any emergencies or anything like that you might need. One thing that, again, it's wise to have some cash on the sidelines. So if we do get another pullback like we saw in March or something like that, you can take advantage of those opportunities. Downturns in the market are opportunities. It's not something to be afraid of. It's something that is natural to the market, and you need to take advantage of those. Why we own bonds, again, to generate income. Bonds, whether you're doing it through a bond fund or individual bonds, they're a way that bonds have a specific maturity. So if you know that you have something coming up, let's say in retirement, you want something to mature where you get your income and your principal back at that time and can do something else with it, you can plan for that with bonds. Bonds really do dampen the volatility of a portfolio because bond prices tend to perform inversely to stock prices. So when stocks are going up, bond prices can go down or kind of stay level. When stocks go down, people rush into bonds, which pumps up their prices. So it's good to have both in the portfolio. When we talk about diversification, it's not just diversifying between owning a couple different companies. We really want to diversify between sectors and between growth and value. Here's a kind of an example of where a client might have thought that they were well diversified, but 42% of their portfolio is in financials. And when there's a hit to the financial sector, this person's portfolio is going to go down a lot more than if she was more diversified among different sectors. People are buying a lot of computers and software. The IT sector is going to go up, but it won't necessarily have a big effect on say consumer discretionary or something like that, or healthcare. So again, it's important to have proper diversification in the portfolio among different business sectors, but also among different styles like growth and value. Here we talk about, I just mentioned value investing and growth investing. Value is typically something where we see a stock's price has been hammered, and it's at a very low valuation. Perhaps it's been oversold. We want to pick those kind of companies up. A lot of times value companies, especially those with dividends, offer a fantastic opportunity to pick up good companies that offer income through their dividend as well as future growth. And then growth investing are things where you're buying firms, a lot of the Silicon Valley firms that are that have above average growth expectations. They may not be throwing off anything as far as a dividend income, but we expect large capital appreciation from owning their stocks. There's been a big argument, but not an argument, a discussion between growth and value. Growth has been leading for the last several years. We tend to think they fall in and out of favor at different times, so it's always good to have some of both. But we do see growth, I think, continuing, although it has led for the last several years, so it might be time to start building in some value. This shows different asset classes and kind of illustrates the point on why we want to be diversified and why we want different asset classes. No one asset class is the top performer every single year. And in this chart, if you kind of look at like the tan boxes, that's emerging market equities. They're a leader in some years, and then in the other years, they're towards the bottom. But if you look at the white boxes, which is a moderate growth and income portfolio, a well-diversified portfolio, the performance falls right in the middle year in and year out. So by owning those, we can get a good, steady, reliable portfolio that provides returns and income. These are some disclosures that we can share if we need to. It gives you some of the definitions for some of the different items that are in there, so you can skip past these too. So a couple strategies we like to use are systematic investing, being diligent and staying in the market, and really taking a more of a long-term outlook on your investments. So we'll get into these three in the next couple slides. So systematic investing. A lot of people will talk about dollar cost averaging, which that's like systematic investing. So the idea is to invest a fixed dollar amount, whether it's monthly, weekly, quarterly, whatever your time horizon is, whatever you can do. We always stress that you should be building, just like you're saving in your savings accounts and things like that. Put some money towards an investment portfolio. You'll be rewarded over time. So a fixed dollar amount, when market prices are high, what that does is it would buy you less shares of a stock that's highly valued. And in down markets, it buys you more shares of the stock. So it kind of protects you, and either it protects you from buying something too expensive, and it helps you take advantage of something that is trading at a lower valuation. A very important part of this strategy is to pay yourself first. Figure out what you can afford to do and put that into the portfolio first. Don't let that be the last thing after paying your bills and buying your Starbucks daily and buying that new TV. Pay yourself first, put that money in the portfolio, and then work on everything else. And part of figuring out what that amount is again, working with me, and we can understand what your cash flow needs are and your budget needs. And we can determine what we can allocate towards a systematic investment. And again, in adjusting your habits, perhaps maybe you don't need that $3,000 TV, but the $1,000 TV looks pretty darn good, and you can't quite tell the difference in the picture. It just happened to me, so I'm using that as an example. But that's an extra $2,000 you could put away in your investment portfolio, and that $2,000 over a 20-year time horizon will pay you and pay you back. The cost of market timing. So we talk a lot about trying to time the market. If you're trying to sell your portfolio before a market downturn, there's a lot of people talking about that right now with the elections, and they're worried about who's going to win and what that could mean to their portfolios. So timing the market is extremely difficult to do, even for a seasoned professional in Wall Street. Trying to sell at the top and buy at the bottom is very hard. And so our approach is that we develop a plan that will, and we know that during the course of our investments, we're going to have down markets and we're going to have good markets. The idea is to stay invested. You have to be right twice when you try to time the market. So we'd rather you stay invested, systematically invest. And this chart just shows you the importance or the detriment of trying to time the market. Over the last, this is going back to 1990. If you'd remained fully invested this whole time period, your average return would have been 7.4%. Missing just 10 days in that time period, you would have cut your returns by a third or so, almost a half. And if you missed 40 days by trying to wait and see when you're going to put your money to work, you could have lost money. So especially after the 2008-2009 crash, you had a lot of cash sitting on the sidelines, and people were still very sold at the bottom, wasn't sure that it was over. And I can tell you from experience, I've seen clients that had never put their money back in the market, and they gave up 300% upside return on that money. Next slide. Again, whether it's Fed policy or elections or different events can cause short-term market volatility. This just is another example that illustrates the importance of staying in the market, taking a long-term approach, being diligent with your portfolios, and investing normally. When downturns happen, you take it in stride. Everybody, I think, understands that investing will have up days and down days, but when you're in the throes of a down market, it's the emotional reaction a lot of people have is to just sell. And part of my job, I think, is as much educating clients and helping them put their plans together as much as I am almost a psychologist and talking them through staying in the market and how we see things over the next 6, 18, 24 months. So among the things that we look at closely is your asset allocation, which we said, and this is an example where perhaps this is the proper asset allocation for a client, where they're 45% in stocks, 50% in bonds, and have a little bit of cash. But over time, different markets could throw this portfolio off. So next slide. So depending on market conditions, that same portfolio over time could turn into a 65% fixed income portfolio and only 30% equity portfolio. So it's important that we review these things on at least on an annual basis. Typically we're talking to clients once a month, once a quarter, depending on what clients are looking for. But there's different ways we can address that. And one way is to add money, so that you can add money back into the equity portion to bring your portfolio back into balance and in line with your needs. Another way is we trim the fixed income portion of it and bring it back into line that way. The risk there is that maybe you give up on an opportunity of further gains in the fixed income market. So there's different ways that we correct these portfolios and manage these portfolios. And a lot of it is just, again, through discussions and regular monitoring and talking with our clients to figure out what their needs are. Needs change, objectives change, so we want to always be on top of that. So you might say, what can you do today? Well, it's kind of hard. There's no one answer for everybody, because everybody's situation is unique. I would say the one thing you can do today is start off by contacting Dr. Hu and reaching out, and she'll get you in touch with me, but we can start having a conversation. And I think that's the most important thing is you got to start with, it all starts with a conversation. And through that conversation, we will determine what the right plan is for you and get you on track to be successful. If you're middle-aged, in your 40s or something like that, and you have a big concentration of stocks, maybe the right thing is to stay in that. But we just don't know until we sit down and talk with you. The answer is different for each individual client. This is an evaluation. Sherry, you can send that to clients if you like. Next slide. So these are just some disclosures talking about the risks in the markets. Because Wells Fargo is a bank as well, just want to be very clear. None of this that I'm talking about is FDIC stuff. Markets do have risks, and that's why we are very careful and diligent in creating a plan and sticking to that plan. That's how successful investors invest is by creating a plan, and no matter what, you stick to that plan and you take advantage of opportunities in the market. And there can be, we can do tactical shifts and things like that where we might raise a little bit of cash if markets seem overvalued and things like that. But we're never going to, tell you to go all, 100% cash or 100% stocks or bonds or anything like that. We develop a plan and we try to stick to it. So I want to thank everybody. I'd like to really thank Dr. Hu for inviting me, and I really look forward to working with them as a strategic partner. You have a ton of resources. We're only scratching the very surface of this with Wells Fargo. I look forward to talking with every one of you and developing the plan for you and show you the difference of what working with Wells Fargo can do for you.
Croft, can you talk a little bit about, compared to other financial or wealth managers, what has a special or some other resources other investors do not have?
I think one thing that sets us apart is our ability to really to service the high net worth and ultra high net worth client. So a couple of things from the standpoint of our platform. Wells Fargo has we manage a lot of our own portfolios, but we also use outside managers, like institutional type managers that we might use for some clients. And that could be in equities or fixed income. Everybody's going to have, every firm is going to have their different managers and things like that. I think where we excel, we have a private bank offering through the Wells Fargo Private Bank. That's for clients of 5 million or more with Wells Fargo. Through there, we have specialized, what we call specialized wealth services. So we will sit down with clients and we'll review their estate planning documents. One of the biggest things we do is work on clients with their estate plan to help mitigate, tax effects on their estate, using different strategies to help increase the legacy they leave behind. Like I said, whether that's for their family or whether that's to give it away to charities and and do something that's important to them. With our estate planning group, what we'll do is we have attorneys and CPAs on staff. This is a service at no charge to our clients. What the clients can do is hire us on a fee basis. It's usually a 6 to 12 month engagement where we will help them really lay the foundation and groundwork for their estate plan, help them through conversations and reviewing their cash flow needs, their assets. A lot of people have business interests in real estate and mineral and timber rights and things like that. How that estate plan should look. We basically put together a draft form and we'll recommend attorneys that they can go to actually draft the documents. We don't draft the documents, but what we do is through that engagement, save you a lot of money in attorney's fees, because what we charge is going to be a lot less than what an attorney would charge you on an hourly basis. And you can essentially give them a sort of a rough draft of what you want. It saves the attorney a lot of time, saves you a lot of money. And also through the specialized wealth services, a lot of our clients are big real estate investors and maybe they want to buy a shopping center or something like that. We have access to specialized financing and things like that. I mentioned timber and mineral rights. We can manage mineral and timber rights for those clients. When it comes to real estate, we've got clients with thousands of units of apartments and things like that. We can manage their real estate. I really think that's kind of what sets us apart. And honestly, I get asked that question a lot. It's who you're working with. A lot of firms have similar services. The difference is the team that you're working with, how much they involve their other partners, because it truly is a team effort. And I think that's our biggest asset. I've been doing this for 10 years. I love having great conversations with clients, and that's really what it is. It's being interested in your client and asking the right questions and in order to find the answers.
Thank you, Croft. I want to thank you for all the good information you have brought to us. And there's several questions we'll ask after my speech. Okay. So now I'm going to give a very short information about annuities. You see my screen, right? Okay. Yes. So we want to share a little bit of this. This is one of the strategies we can use to help you to protect your retirement plan and help you to weather your market risk. That's the main topic of today. So first, we want to say how we evaluate how successful your retirement plan is. So there's two criteria here. First, it's a safe, right? You want to make sure you have your money there for your retirement when it's time you need to draw the money. And second is we want to make sure you have your lifetime retirement, last for your whole life. So that's the two criteria. And let's say what are the things we have in the past to address these two criteria. So many of you have heard of pensions, although you may not have it, right? Like a lot of organizations, they used to have pensions and then they took that away from people, but there's still some government, some like schools, some universities, they still have pensions for you. So with the pension, the commitment is if you have worked for like 30 years or long time for the job, and when you retire, you get a certain percentage of your income, right? I heard of that from a lot of the public school teachers. They told me if they work for this job for 30 years, they should be able to walk away with like 90% of the income they used to have. So that gives them a security for the future retirement. But unfortunately, most of us do not have that anymore. Most of us. So let's say, what do we get? So we normally get a 401k and the IRA today. So the logic is, with that change, the companies do not have to carry the big burden on itself. What they are doing is they give this burden to yourself or to the institution who's helping you manage your 401k and IRA. So what's the big problems with 401k and IRAs today? Because there's two risks. There's two risks as we talk about. One is about the principal safety, like the money, how safe they are. If the market crash, like what had happened in March, you remember in March, just in like 3 weeks, the market dropped more than 20-30%. So if market crash again, how much money you have left in your portfolio? And second question, second risk for your current 401k, 401k IRA is longevity. So as you probably heard, people are living longer and longer. The current average life is probably about 80 years old. But in the next 30-40 years, when we really get to the retirement age, it's not unusual we can live 90 years old, 95 years old, even 100. So think about before, if you retire at 67, you average life is like 78, you probably only have 20 years of, less than 20 years of retirement life. Now, if you live all the way to 90s, you have 30 years of retirement life. Life gets longer and inflation is there, and how you can make sure the money you have in your retirement plan will last for your lifetime. So there's two big risks there. So here comes with the solution. One of the good solutions is annuity. You probably already heard from Kraft. When you do a portfolio for your asset, you want to have some fixed income. So annuity is a part of that fixed income. So when we talk about fixed, which actually means you have a principal means your money, okay, your principal protection. Like when the market crash, you don't lose that much money. You don't lose at all. Okay, so here's annuities doing that for you. And you can think of annuity simply as pension. It's like a pension for you. And there's a few things you need to know about it. There's different types of annuities. There's different types. And like investments, annuities also need to address your objectives. There's so many times they address different objectives. So you really need to know what you want and talk to the right people, and in order to get the right plans for yourself. Okay, let's talk about quickly what are the 3 types of annuities. So there's one type called variable annuities. So for all the annuities, it's a tax deferred growth, kind of like your IRA and the 401k for retirement plan. It's a tax deferred. So if you don't really understand what's tax deferred or what's the difference between tax deferred and others, you can talk to me later on about the tax structures of the investment you can do. And there's fixed annuities. Basically, fixed annuities give a fixed rate of growth. And then there's a newer type. Actually, this is the trend. Like all the market right now goes to this trend right now, going to the fixed index annuities. So what are the difference of those 3 things? Let me say a little bit here. So for the variable annuities, so there's no principal protection. So basically, it's a similar like your money still goes to the a portfolio of investment. There's a fixed income, there's a part of a large cap investment and international, it's combination of everything. So when the market crash, you still will carry that market risk there. But when it's time for you to take the retirement plan, there is a plan there to help you to get your lifetime income. There's a certain ways to do that. And you have the growth like a market growth, okay? And it's also tax deferred as we just talked about. Okay, so another, remember I talked about second type is a fixed annuity. Fixed annuity give you fixed interest rate, kind of like you save money in the CD in the bank. So depends on where you find the different plans. So the fixed rate can be pretty good. Actually, the best I can find from hundreds of providers right now is like 7.2% for your retirement account. It's fixed for 10 years till the time you are going to take the retirement income. So there's a lot of good stories. Actually, personally, I have some annuity here in this portfolio too. So that's a pretty good fixed. Okay, so this is one example of the one I told you, 7.2. I just screenshot this page yesterday from these providers. You can say if first year you get 7.2% for your retirement account, for your retirement benefit account. So it goes for 10 years, 7.2. And when you put in 100K, and the money will grow to about 200K. And depends on the age you are, you can take a fixed income for your lifetime. So if your account have a 200K, you can take about 5%, like $10,000, but guaranteed. No matter how long you live, you can live 100 years old, 120 years old, you get that money. Okay, that's the last one. That's my favorite one, actually. That's as we talk about the market going this way, it's called a fixed index annuities. So this fixed index annuities has all the features we talk about: principal protection, have a tax deferred, have a growth potential, and when we talk about index here, actually a lot of money have a higher returns. It's like index returns in your portfolio. But when the market crash, market drop, you don't lose any money. It's guaranteed from the annuity companies. So this is pretty good. There's a lot of details, but I just want to go through quickly because every family has different situations. So just remember, we talk about different types of annuities for variables. So it's like one biggest risk is you don't have a principal protection. When the market crash, you'll crash, okay? But for the fixed and the fixed index, it's guaranteed. Your money is safe there, you have lifetime income, okay? And there's one thing, just be aware, there's an inflation risk because, you know, if you think of we'll live another 30 years after we retire, the market will grow, the inflation will be higher or lower, depends on how it is. So to guarantee we have lifetime income is not easy. So that's one thing, just raise your attention here. Okay, so that's everything we talk about. The current annuity is a wonderful tool for you to address your risks for your life. And I want to give a quick example here. So I know in the past, people thought about annuity like 5 to 10 years before they retire or they are starting their retirement. But nowadays, even younger people like me, actually, I'm not that young, I'm like 40 in my late 40s, but I have already done a lot of different annuities. I use these newer types of annuities, similar as my mutual funds plans to do my 401k and IRA. So I'll give an example here. So for example, this is a real case. Okay, real case I have handled. And there's a 44 years old man working actually in our local place for a high-tech company. He has $200,000 in his 401k, his last 401k company, his last company. So he can move it over. And what his goal is, he wants to find the best option that can give him the most retirement income when he's in his retirement age. He wanted to start like 67 years old. That's recommended age by IRS. Okay, but he also worried about the stock market risk. He wants to find out the way he can manage the risk. So we did a lot of search for him. We probably look at over 20 different annuity plans, and we compared. We said we do big data analysis. So I know it's pretty too small for you to look. So we run different scenarios. We have a professional data analytics software to do this. So we run numerous portfolios. First, we will run what if he's continue to do what he's doing right now in his 401k account, assuming he's getting S&P 500 returns. You know, like most retirement plan, if they can capture like 6-7% on average returns, they'll be pretty happy. So this is he's 44 years old, depends on the market up and down, and his money will grow in this account. And when he's 67, he's going to take the income. This is the accumulated income. He's going to take income, and there's inflation. So every year he will need to take a little bit more, like 2 or 3% more. So if he's 94 years old, that's 94 years old. That's how much accumulated income he's taking out. He can take out from his account. This red curve here is after tax, because you remember 401k is tax deferred. It's not tax free. So when the time you start to take the income, you have to pay the taxes. So this is his after tax income accumulated. So at age 94, that's the average age we used for calculation. And he's going to get the money. And another comparison we used is a plan. I found it's very, very, very high returns and safe. And again, I actually put some of my retirement plan here too. Okay, there's a lot of numbers, but overall, he can start to take money from 67. There's a certain number we already calculated, as you know, like we use software, and also we compare with this plan. I'll give you a big number here so you can take a look. So in this option 1, we use mutual fund, as you know, as probably you do, we use the average benchmark returns as your returns. So initial fund all start with 200. For this strategy, we use one of the, growth annuity, very good plan here. And at 67 years old, using this plan, the person can start to take retirement income of $38,000 and then probably grow 2 or 3% each year. And he's going to be okay till 94 years old in this plan. But in this annuity plan, he's able to take $45,000, $7,000 more per year. And also the growth over years will be a little bit higher than he can get from mutual fund. And let's look at the market risks. As we said, in the mutual fund, especially now there's an election coming. Also, there's COVID-19 still hanging on. So the market risk is still pretty high. You already see that in the past week, there's a 3% loss in a day. There's a gains in the end. There's different scenarios there. But in this annuity plan, as we just cover a little bit, so there's, if it's a fixed or fixed index, there's a guaranteed no loss for your principal, for your money there. So there's not much or not at all market risk here. Another criteria we look at is liquidity. Liquidity is more like when you need the money, can you take the money out, right? You want to have some liquidity there. So there's some situations happening, you want to have the money. For the mutual fund option we put here, 401k IRA options and these annuities, it's the same. It's IRS requirement. Before 59 and a half, you pretty much cannot take the money out. If you want to take out, there's a penalty from IRS. It's like a 10%. But after that, the money is yours. It's pretty flexible. You just need to pay the taxes. That's the one thing here. So I just make it really quick. because we do have this 1 hour limit for our today's seminar. And that's my name and my contact information here. And my office manager, Tom, will send out a link there. If you want to check with us, probably only for a quick 30 minutes Zoom meetings, we can go over your questions with you for your specific questions about, your family situations, your specific needs. And with only a few minutes left here, we'll answer a few questions here for you. And if you want to raise your hands, you want to talk, you can do that too. So
Sherry, if I could add something just to the end of that.
okay.
Yeah, one thing I did not mention as far as asset classes in my presentation was annuities, and we are using annuities very much in our practice, especially with low rates right now that you're getting in bonds and fixed income. We really look at annuities to kind of be part of the bond allocation.
Yes. Yeah.
So those fixed indexed annuities can provide, very
good returns, right? Yeah, I know. Yeah, so that's how we and the Kraft we work together. Is probably I help with the principal safe planning, principal safe like annuities and other portfolios, and the Kraft will help with the different asset class, the equities and the other investment here. So Croft, we have a few questions. Let me read to you. I think you probably are a good one to help with this one. I think there's one person asked about how many times per year should you rebalance your portfolio in a volatile market like currently?
Yeah, that's a good question. Honestly, we usually rebalance portfolios probably semi-annually, about mid-year and towards the end of the year, just to maintain our proper asset allocation. In volatile markets, you don't want to do it too often, or else there could be, depending on the kind of account that you're in, there could be different tax consequences for selling things off at gains or or in losses. But so we try to stick to, when it's volatile like it is, we still treat the portfolios as normal. We would reallocate and rebalance about twice a year.
Okay.
That's a good question. Again, we want to take a look at specifically at the portfolio to see, there could be different things that we're holding. If it's riskier assets that have dropped a lot more, we might be able to do a little more tailored rebalancing than just sort of a blanket rebalance. So again, it's kind of specific to the client.
Yeah. So here's another similar question. The attendee is asking about how to balance bonds and the stocks.
Yeah, I saw that question. That's a great question, because in March, they're right. The bond prices really almost reacted kind of like stocks. But again, very important is we take a long-term view. We try not to react to short-term anomalies. That's something we've never really seen before. And what it was is a lack of liquidity in bond markets. But if you look at where bond markets are now, the U.S. Treasury, 10-year Treasury market is among the best performing sectors in the market. There, Treasuries as an index are up about 7-8% this year. People don't think of Treasuries giving you that kind of return, especially when it's giving you a 0.8% yield. But Treasuries have offered a return. Corporate bond indexes are up 6% year to date. So that's, again, really illustrates the point where you can't let markets shake you out of a long-term plan. You got to let markets play out, and like I said, if they all present opportunities, whether it's stocks or bond markets. I can tell you, in March, with COVID and everything like that, we looked at a lot of Royal Caribbean bonds. Cruise lines, were we're not sailing and things like that. But we look and we see, okay, Royal Caribbean has a bond that comes due in October of this year. This was back in March. We know that Royal Caribbean had cash on hand to last 18 months without a single dollar coming in income. That bond was yielding 18% at that time. And so, yeah, I mean, you need to, there's opportunities when things like that happen. And like I said, so fast forward several months, year to date, bonds are performing better in some cases than the equity markets. And again, that's why we want to have a balanced portfolio.
Yep. So there's another question about annuity. So I'll address that one. So there's somebody who said it's 5 to 10 years away from retirement, but have a 25% shortage on their retirement income. So will annuity be a good choice? So my recommendation will be, there's a lot of annuities. So I know, because I'm really a top expert in the country for the annuities. So I have a lot of different plans. I know there's some growth annuities. They give very strong returns. So probably we can find one works for your portfolio. All right. So I know there's a lot of questions in the chat. So let's see what's the portfolio. There's a long one. Okay. What's the right mix of bonds for the diversification in this crazy coronavirus market? Okay, so it's what's the right percentage? Volatility is high. So it's very specific to your family situations and also for your goals and how much asset you have and how you diversify it, how much risk you can take as a crafter. And we have mentioned a little bit there. So I would say, when market is risky and when you think you are not risk taker, you probably want to put more in the bonds than in the equity. And also bonds can be different things. For example, annuity, there's a lot of money in annuity actually placed in bonds. Life insurance too, you heard of, there's a cash value life insurance. They also put most of their money in the bonds. So they are all good tools for you to use.
Yeah, again, and Sherry, I would say that again, it goes back to your time horizon. When do you plan on using that money? Another thing we didn't really mention, but there's different kind of fixed income classes, and there's things like preferred stock that offer higher than normal dividends and high yielding dividend stock. So even though maybe you're in retirement and retirement, if you retire at 65, people are living long these days. I mean, you might have 30 years in retirement, so you still need some growth portion in your portfolio. And by using dividend paying stocks as part of your income strategy can also offer you long-term growth in addition to having bonds for income.
Right.
And annuities.
Yeah. One thing for you. Okay, what's your typical fee for the wealth management?
So I'd say on average, it's about 1%. It kind of depends on we tend to, if you're a larger client, we can adjust that down some. But I'd say on average, it's about 1% is what you could figure. And then, and if it also kind of depends on how we're invested. I have some clients that are 100% in bonds. And so if their portfolio is averaging, 3 or 4% a year in a bond portfolio, it's hard for me to charge 1%. So, we really kind of tailor that fee to the client and what they're invested in. We'll, if it's a fixed income portfolio, something like that, we usually get pretty aggressive on the fee, just, so we're not taking so much of the return out.
Okay, one thing I want to let everybody know is, so normally you know how to buy a mutual fund. So mutual fund fee is like a 1 to 1.8%. So what a crafter can do for us is he has access to a lot of institutional portfolios that don't charge that fee. So what he's charging is actually less than what you pay for the mutual fund fee.
Yeah, and so what Sherry's talking about is like specifically like C-share mutual funds. A lot of One thing you'll get when you're working with me is transparency. I make sure clients understand exactly what they're paying for, where the fees are coming from. You know, C share charges 1% a year to pay the financial advisor that sold you those C shares. So while you're not paying them up front like you would in an A share, an A share would pay the financial advisor, could be up to 4% in some funds, but that comes right out of the top. So if you gave a financial advisor, you know, $100, only $96 would go to work for yourself. The other 4 goes to the financial advisor. So some advisors sell clients C shares, which don't cost the client anything up front, but the fees on the back end and that you don't necessarily see are 1% plus the expense of the fund. So like Sherry said, it could be 1.5, you know, 1.8 up to 2% in some different mutual funds. So so you're paying a fee one way or the other. Where Sherry and I have seen working together, we use institutional shares a lot, where my fee of the 1%, you pay to Wells Fargo. That's how I get paid on these managed accounts. And then in the actual fees and the expenses in the funds themselves are lower. So it's you can actually save some money by doing that. And there's some benefits of not being like when you buy a C share, you can't sell that for a year or else they'll charge you another 1%. When you buy an institutional share, there's no hold period. We can readjust as we need to without any penalties.
Okay. Thank you, Croft. And I think our time is up. And we have other things we have to, Prof and I, we have to meet other clients.
We have to get our kids dressed for Halloween.
For the Halloween. Okay, thanks everybody for being here today. And I know everybody has their own questions and you can contact me. Okay, so my manager will text my email address and my phone number there. And then you can make an appointment with me too. And we'll send email to you as well. Okay, looking forward to talking with you. Thank you. Thank you, Croft.
Thank you. Thank you, Sherry. Thank you, everybody, for attending. If you have any questions, I look forward to talking with you and develop the plan.
Happy Halloween.
Happy Halloween, everybody.
Bye.
Bye.
Okay, thank you. Bye.